Dividend stocks, they're praised everywhere as the bedrock of a stable portfolio, a reliable stream of income. But this idea of a free lunch in investing, it doesn't exist. Focusing only on dividends without understanding the trade-offs is a path littered with costly mistakes. Let's start with the most dangerous myth, that dividends are the new interest. This narrative gets popular whenever savings accounts pay next to nothing, but it's dangerously misleading. Interest on a bond is a contractual obligation. Dividends are completely discretionary. A company's board can slash them or eliminate them entirely with no warning. You're not a lender, you're an owner. And ownership comes with full exposure to business risk, management mistakes, industry shifts, pandemics, you name it. Any one of these can hammer profits, and your dividend check right along with it. This illusion of safety leads to the second major pitfall, leverage. Borrowing money to buy real estate can work because a house rarely collapses in value overnight. Stocks are a different animal entirely.
Their volatility can trigger margin calls in a heartbeat, forcing you to sell at the absolute worst moment. Leverage combined with a market downturn doesn't just create a temporary setback. It can cause a permanent total wipeout. More importantly, it destroys your greatest asset in the stock market, time. Strong businesses and markets recover, but only if you're not forced out of the game. With debt, time is no longer your friend. Even if you avoid leverage and pick solid companies, there's the harsh reality of capital. Most people want dividend income to supplement their life, but the math is unforgiving. With a typical portfolio yielding around 3.5%, you need a massive amount of capital to generate meaningful cash flow. Investing $100,000 gets you about $3,500 a year before taxes. That's a helpful supplement, but it's not going to change your lifestyle. Living off dividends requires serious scale. Small portfolios just don't cut it. Then there's the psychological trap. Dividend stocks are designed to be boring. You build the portfolio and then you wait. The problem is, humans are wired for action. We want to tweak, trade, and optimize. But successful investing rewards patience, not activity. This becomes most challenging during a roaring bull market. That's when growth stocks are screaming upwards, dominating the headlines, while your dividend portfolio is just moving sideways. The temptation to abandon your strategy and chase those high-flying stocks is immense. But history shows that investors who lose patience and make that jump often do it late in the cycle, destroying their long-term returns. Successful dividend investing demands the discipline to stay put, while everyone else is chasing performance. So, what's the bottom line? Dividend stocks are powerful tools, not a shortcut to wealth. They demand significant capital, they demand the patience to endure being boring, and they demand the emotional fortitude to accept periods of underperformance. Understanding these downsides isn't optional. It's the price you pay to avoid critical errors, and it's the very foundation of long-term success.